This is Chris Carlson, and welcome to the Boulder Banking Podcast. My guest is Matt Rathjen, Executive Vice President and Chief Lending Officer at Generations Bank. Once students complete their second year at the Graduate School of Banking at Colorado, they complete a strategic project on a topic of their choosing. After completing his second year at GSBC in 2022, Matt decided to do his strategic project on evaluating the future of banks with less than $100 million in assets. Matt did a great job of researching this topic, and I know you will enjoy the insights he shares. Hey, Matt, thanks for joining me today.
Yeah, it's great to be here, Chris. Pretty honored when Mike called and said we were going to talk about some things that small community banks could do to try to get some growth.
Yeah, it's a great topic. And Matt, before we kind of dive into that, can you give us a brief background of Matt Rathjen?
Sure. So I grew up on a small family farm in southeast Nebraska and got my degree from the University of Nebraska in animal science. Worked construction for a few years, worked as an ag mechanic, as a combine mechanic for about 9 years before I got into banking. Got into banking in 2003 with one institution and was there for 12 years. And I've been with my current institution about 7 years now. I'm Executive Vice President, Chief Lending Officer, and I do sit on the board of directors here at Generations Bank.
Well, Matt, here's a crazy question for you. How did that career path, how has it helped you being a banker?
It was a pretty good sized jump going from pounding nails and working construction to turning wrenches and being a mechanic and becoming a banker. I've always had a love for the ag industry, and everybody's like, how do you turn the wrenches down and go into banking? And it's really what I tell a lot of people is that it's really no different. I'm still helping and being involved in agriculture. I'm just using a different set of tools. And that being a computer and the financial knowledge, that I've gained through my banking career. And it's just kind of propelled me, and the experience has gotten me to the point as a banker that I can actually make an impact to the institution I work for.
I love that analogy. You just changed the tools in your tool belt.
Yep.
Perfect. Hey, Matt, tell our audience what the subject was of your strategic project for GSBC and why did you choose that particular topic?
Well, first off, getting to be able to go out to GSBC, I've been excited about going out there and being a part of that program and furthering my education. And I was lucky enough to get scholarship to attend out there. And so I've tried to make the most of that. And with all of my assignments and papers, I really tried to get some relevancy to bring that back to my institution. And I work for Generations Bank, like I said, in Exeter, Nebraska. We have a population here between 500-600 people. And so we are a typical rural farming community. When I started kind of researching what I really should do for the strategic topic, I got to thinking, I'm probably involved with one of the smallest institutions of any of the students out there at school. And one thing that kind of came to mind was how do we maintain that viability of a small community bank in an industry that continues to consolidate and virtually size down the numbers of banks. So I thought if I could research that a little bit to help my institution go out and get a little bit of growth strategy going, what is it going to take for us to survive? When you start looking at some of those statistics, the number of banks under 100 million just continue to, decline in numbers. And it's kind of a little bit of an alarming trend as you look forward. So my topic really covers, what do we do to get to that $100 million threshold, or what can banks do under $100 million threshold do to grow and survive in an ever-changing, consolidating industry?
Well, in your research, what did you find are the key reasons why banks under 100 million in assets are declining?
I think when you actually look at the numbers, you see them nationwide and even down to the local level. And in some of that research, I was kind of astounded. And when I took a look at Nebraska, we were seeing probably a 10% decline in 2022 of just Nebraska banks under 100 million. And as I started researching this and looking into it and trying to figure, I kind of come down to those four basic things. One is the regulatory pressures. As laws and regulations come and that regulatory environment continues to increase, that puts a lot of pressure on these smaller institutions. Number two, I think the ever-changing world of technology in our industry is expensive. And when you take a look at the smaller institutions and being able to average that cost of that technology over the number of assets that you have, the larger banks certainly have an advantage there to continue to increase and build that technology stronger. The third thing that I came up with kind of falls into succession planning. So as I researched some of the banks across Nebraska, sometimes it was regulatory, sometimes it was technology. The other side of it is a lot of the banks that are under 100 million in assets are kind of a family-owned community bank in a rural town. And they may not have a succession plan where kids want to come back and get into the industry. They might have moved away. And so when that family bank decides, the family that owns it decides they want to retire, that's kind of it. So they'll put the bank up for sale and sell to another institution. My fourth one got really interesting for me because I think it boils down to stockholder base and succession of that stockholder base and how your holding company was kind of set up and designed. And I think there's some dynamics there, both from a shareholder standpoint as well as the board of directors. Who's going to go ahead and continue on this succession plan, and how's that going to change, especially as fast as banking is changing. But there is one other thing there. Those are kind of the four key elements. But once we got into the pandemic, a big topic then becomes how do you keep and retain top talent in these small rural communities and rural banks. And I didn't hit a lot on that on my paper, but it's certainly a concern for those banks that are under 100 million.
Yeah. So Matt, as you went through all your research, and obviously you're focused on banks under 100 million, do these same 4 or 5 things apply to a $200 million bank, a $300 million bank? Was when you were thinking about it, where did you think that there was a tipping point?
The tipping point, I think, becomes at 500 million. And when you look at some of the statistics, especially the Nebraska puts out the statistics on bank charters and mergers and all that each year, I think the tipping point was more at 500 million. And what I'm seeing is if we lose, 5, 6, 7 banks under 100 million, those banks that are greater than 500 million in assets seem to be adding numbers. So you could kind of see by that trend that the larger or 500 million plus dollar banks were going ahead and acquiring the under $100 million banks.
Great. That's great information. Well, I know as part of your research, you talk with Richard Baer, who's the president and CEO of the Nebraska Bankers Association. What did you learn from your talk with Richard?
That was a great interview I had with Richard. We spent about an hour kind of visiting about different things, and he's been with the Nebraska Bankers for quite a few years. So he has seen a lot of this transition and consolidation within the banks in Nebraska. And we talked about these 4 or 5 issues of those main reasons. And he said there's really not one of those reasons that sticks out and says, well, this is it. It's kind of a combination. Some of it's don't want to fight the regulatory issues anymore. Others are they didn't have a succession plan, or the stockholder base didn't necessarily agree on growth strategies or continuing on. And so there was really a combination there. So as we kind of discussed those reasons, the one thing that I did learn from Richard that was really instrumental, he says, I've been a part of a lot of these acquisitions, mergers, and he said that it really boils down to, if a bank wants to grow and acquire or merge, they need to be very deliberate in their growth strategy. And those banks actually sought out targets that aligned with them. But he said it was very deliberate, well thought out, whether they were going after banks that just fit the size that they felt that they could buy, or maybe some banks that they knew didn't quite have that succession planning up to speed. And they created deliberate relationships and communicated their intentions that, look, we're going to help you out, and we'd like the opportunity to buy you someday. And that could even be small institution to small institution, whether you develop a participation relationship with them and kind of help each other back and forth as you're small, which could lead to some talks down the road to negotiate a merger or an acquisition.
Now, I know as part of your research, you had conversations with other banks. What did you learn from those conversations?
The first bank that I really looked at was my former employer, and they've seen an extreme amount of growth in the last 20 years. They had a pretty specific plan. They kind of went through South Central Nebraska, and they looked for communities, small rural communities with good ag loan volume, that they were kind of the only branch or the bank in town. And they kind of have been very, very successful with that train of thought. And then after time, they got to the point, well, this bank decided that it was time that they were going to sell. They call their banker friend and say, well, we went with this larger bank to sell to because it was so seamlessly. They've done it a number of times, and it was a smooth transition. But they specifically went towards towns that only had one bank in that town, and for convenience, they retained most of the customers. The second bank that I looked at, they went all in, which kind of surprised me a little bit. They took a bedroom town of a larger metropolitan area, and they went all in. They got a lot in the middle of the town. They built a beautiful bank building, and they pursued more of a, well, if we show our commitment to this community, hopefully that comes back in growth within that community. And it worked tremendously for them. As people were moving out to acreages in this bedroom community, they ended up building some branches then in more of the metropolitan area to give those people that were moving out to the country a chance to transact their business either in the town they built the main branch in or the town they were driving to work in. So they were looking at growth of population, growth of industry, and that turned out real well for them. The third bank that I looked at, they went and started getting a few loans over in the Omaha area. Of course, Omaha was big, commercial real estate construction, loans, booming, good population growth. And they thought, well, we've got our foot in the door here with a few loans. Let's just go ahead and open a branch. That branch was closed within probably a year and a half. And the reasons for that, as I visited with them, they decided they were going to take one of their former employees and move to that community and run that branch for them. And that individual didn't necessarily recognize the market. The people in that market didn't know anything about him or any of the people working in that branch, and it failed horribly. At the same time, they opened up some branches in some other communities, and they got local people that knew and understood that market to go ahead and run and manage that branch, and they become very successful. They actually hired a banker from another branch, and that banker ended up bringing some employees from that other bank, and they made a good run at it there, and really were successful in those other branches when the one branch up in Omaha failed miserably. So, there's a lesson to be learned there. It takes the right person at the right time in the right place. So that was an interesting one. The last bank that I took a look at, when we talk about growth, it doesn't always mean asset growth either, although my paper was structured under the asset category of banks under 100 million. This bank happens to be a $52 million bank, so it actually fits within my under 100 million in asset size. This bank decided to specialize in one product, and that product was guaranteed loans through the FSA. And they actually expanded on brick and mortar to their bank and set another 10 cubicles in there. And they got so good at running the FSA guaranteed loans, neighboring states' FSA departments were sending customers to them. They said, here, contact this little bank in Nebraska, and they'll get this set up. Well, on those guaranteed loans, only 10% of that volume is actually hitting your loan volume. The rest of it's guaranteed, so it doesn't hit your books. So they didn't really go after growing an asset size, but what they did, they perfected one type of loan, and they are probably one of the most profitable banks in Nebraska at $52 million in asset size.
Well, there's 4 different ways to skin that cat, as they say.
Yeah, that's for sure.
Well, what are the key steps smaller banks need to take to survive, in your opinion?
Well, I think if you're under 100 million in assets, I think everybody hears, well, we need a succession plan, we need a capital plan, but I don't know how serious some of these smaller banks take that, or they don't have the energy or the know-how to really put that together. So I think some of the key steps are, that strategic plan is there as a roadmap for your bank, depending on where you want to go. It kind of lays it out, who's going to be responsible for what areas of this. So I think the first step is developing that strategic plan. My next step, you've got to have a capital plan if you plan to grow through merger acquisition or starting a branch or LPO. You got to make sure you're in a good position capitally to be able to make that happen. Then you need to really think about the succession of management and the directors. Who's going to carry on the torch when we are, say, the mom and dad of the family are going to retire. Maybe there's kids coming back, maybe there isn't. But who's going to carry on the torch? Is the bank just done here, or are we going to sell? So I think that succession plan of management, directors, who's going to take care of things when they're done, I think becomes very important. The other thing that I got into then is I think there needs to be a shareholder succession plan. And part of that goes into that growth strategy. And I learned a lot through this side of it as I visited with my president as well. If you're thinking about a growth or an expansion, you got to think about what the structure of your holding company looks like. Because if you decide that, okay, we've got this opportunity to grow through a merger or acquisition, but your holding company is set that when, let's just say, another shareholder isn't happy with that decision, but the whole group of shareholders decided to go ahead and let's grow the bank in this fashion. You could have a shareholder say, well, I don't think that's smart at all. I want out. Well, now you've got the holding company buying no shares of stock back if you're set up that way. And so can the bank, did that capital plan take into account both growth as well as the possibility of buying out a shareholder as well? And so you got to take a look and see where your capital position is, where your borrowing power, if you got to go out and do a stock loan. Most people prefer not to do a capital campaign to do that. So those are some things that fall into that shareholder succession is everybody on board. Then you got to, the next part of that is get everybody on board with the actual expansion plan. Are we going to do a branch? Are we going to do an LPO? Are we going to go out and try to merge with a bank or acquire a bank? And I believe the board, the shareholders, everybody has to buy into that and kind of be on the same page, or it could affect some of those capital requirements if you have a couple of shareholders that aren't on board there. But overall, I think once you have all your plans in place, the last step in that is going to be you're going to have to get the employees to buy in. And what I mean by that is the employees are going to have to be on board with that growth strategy, because you're going to be requesting extra time, extra effort on their behalf to help make that growth expansion necessary. So in a sense, your employees even have to buy into this chance to grow.
So, Matt, based upon the research for your project, what excites you most about the future of smaller community banks?
Well, as I was researching this, I didn't know how granular to get with this. And I started looking at some numbers that started taking me out to the amount of money that's borrowed in Nebraska in the most rural of counties, which is where most of these small banks are in these communities. And I decided maybe not to go that deep. But part of that, when I started going down that rabbit hole, it talked about the volume of dollars, especially in Nebraska, that are lent to in agriculture from banks that were less than 500 million in assets, which leads us back to, banking truly is relationship-based business. And when we start looking at the size of these loans that we're doing in agriculture and in small business in general, there needs to be a relationship there. You need to work through the ebbs and flows of what those industries are seeing. So it gets a little bit tougher just relying solely on technology. We can use technology as a tool, but we need that relationship. And I don't know if you can get away from that side of community banking. It's we got a kind of a motto, get to know us before you need us type of thing. And I think that relationship banking is going to be key. And I think that's what's going to keep the community banking feel alive.
Let me do a 180 on you. What scares you most about the future of smaller community banks?
What really scares me is the trend that we're seeing in the statistics and the smaller community banks getting ate up by the larger institutions. Even as these small banks got together, most of the shareholders were community members. They know the impact that a bank has in a small rural community. You lose your bank, you lose your restaurant, you lose your grocery store. There's nothing to bring people to town, which affects your school. There's so many parts of that, Chris, that are so key in keeping a small rural community bank alive and doing well for the prosperity of these communities. And so that maybe scares me the most as I look at not just in banking, but everything in general. The consolidation going down, I think it's going to have a major impact on our communities. If we continue to consolidate, because the larger bank may say, you know what, that's not as profitable as over here. They closed a branch in that town. It's a huge inconvenience for those community members. And I think that's scary to me with the way the economy, everything is today. I'd hate to start seeing some of these smaller rural communities failing, or I guess reducing with the consolidation and losing the banks in those towns.
Well, Matt, you've shared some great insights, and my guess is there's going to be some of our listeners that maybe would like to go a little bit deeper with you on some of them. So what's the best way for somebody to contact you?
I can be reached at mostly by email. That email address is mrathjenectfnb.com. Rathjen at connectfnb.com. They can give me a call here at the bank too. And phone number for Generations Bank here is 402-266-5931.
Matt, I know you have a lot of things going on. I just want to thank you for taking time out of that busy schedule to visit with us today.
You bet. It's been an honor and pleasure, Chris. Thank you.
Thanks, Matt.